Welcome to Chapter 20 of the Wealth Management Essentials course, where I will be talking about debt securities. There are 5 different learning objectives in this chapter. We'll be talking about characteristics of debt securities, types of debt securities, risks, debt market trading mechanics, and the term structure of interest rates. So, debt securities have various different characteristics. First off, there are a lot of different issuers. So there are government issuers who would typically issue T-bills, fixed coupon marketable bonds, and real return bonds. Then there's also non-government issuers. So that could be like a corporation. It can also include things like asset-backed securities and bonds from foreign corporations and foreign governments. With bonds, there are a few various different features. So with each bond, there is a principal or face value. That is the price of the bond at its issuance. Second is the payment provision or maturity date. So some bonds might be a 5-year bond or a 10-year bond where you have to wait that many years to get that principal payment back. And then there's an interest payment or coupon rate. So if the coupon is 5%, then that means you will get a 5% coupon per year. Sometimes they could pay it out semi-annually or annually or quarterly or whatever. And then there are sometimes some bonds that do have options attached to them where you can call the bond and sometimes even get equity and some things like that. And so bonds are typically seen as a safer investment, and part of the reason for that is because you are guaranteed to get your coupon payment and your money back if the bond or if the company doesn't go bankrupt. Now, if they do get bankrupt, there is sort of an order as to who gets their money first. And so the ranking, the first person is the first mortgage liabilities and asset-backed securities, whereas second is secured debt and unsecured debt. So that's where the bonds would fit in. And then 4 and 5 is preferred shares. And then the last people to get the money is the common shares. Usually there isn't any left at that point. Now there are some different money market securities. So this would include something like T-bills where the term is 3 to 12 months. It is the shortest term marketable debt issued by governments. You also have banker's acceptance, which is something like a commercial draft drawn by a borrower for payment on a specified date by the borrower's bank. They usually trade in multiples of $1,000 with a minimum investment of $25,000. Commercial paper is an unsecured promissory note issued by a corporation or backed by a pool of underlying financial assets. The issue term ranges from less than 3 months to 1 year, and they also trade in $1,000 multiples with a minimum of $25,000. There's also what's called mortgage-backed securities. So a mortgage-backed security is an investment that represents ownership of the cash flows from a group of mortgages. There are 2 different types. You have residential mortgages, which are insured by CMHC. You have open NHA MBS, which contain clauses that permit borrowers to make early principal repayments, and then closed NHA mortgage-backed securities, which do not permit these early repayments. So sometimes the problem with these mortgage-backed securities is that people can repay their mortgage. And so then your investment just becomes prepaid and you no longer get that return. So that can sometimes be a downside, which is why they created a pool of mortgage-backed securities, which we will discuss later. Now a quick example, so you have a mortgage-backed security carrying a coupon of 6%, which was issued 2 years ago. It is offered at a price of $102 per $100 face value. The reason for that is because the interest rate now is less than 6%, so that's why the current value is higher than that face value or initial principal. Now if the pool factor for this issue is 0.95623, then the actual cost of the mortgage-backed security before accrued interest would be $97.53, which is just calculated as that 102 times the 0.95. So that's sort of how you would calculate the actual costs of mortgage-backed securities. just with that quick example. Now, there is some different risks of debt securities. So one would be credit risk. So you have the risk that the company that is issuing the bond will go bankrupt and you won't actually get your principal back. So that is one risk, the most prevalent risk. There's also interest rate risk. So if you buy a bond for 5% and say interest rates go up to 6 or 7%, well, then you would have bought the bond for, let's say, $100. And its current value would have decreased because now you can buy a bond on the market for a higher percentage at face value. So you do have that interest rate risk where if interest rates go up, bond values go down. They have that inverse relationship. You have the reinvestment risk, which is say you buy a 1-year bond for 3%, and then the 1 year is up, you get your money back, and maybe interest rates are lower. Then if you want to buy another bond, you have to buy it at, let's just say 2%. So there's that reinvestment risk where interest rates may be lower when you're ready to reinvest. There is a timing risk. So again, that just goes along with the price of bonds and interest rates. So you might buy a bond at a pretty bad timing. The price of bonds, they do fluctuate in the short term. So it is possible that you could lose money if you do choose to sell that bond before maturity. The yield curve risk also stems from the fact that bond prices and interest rates have an inverse relationship to one another. So again, the price of bonds decreases when the market interest rates increases and vice versa. You have inflation risk. So sometimes if inflation is quite high, sometimes it could be higher than the actual rate you're getting on the bond. Well, then the real rate of return could be negative. Marketability risk occurs when a security cannot be sold or requires a deep discount to be sold. So debt securities, they are definitely a lot less liquid than equity. So that is another risk with debt. You have the exchange rate risk, especially when buying foreign bonds. There is that extra level of variation where the exchange rate could change. Volatility risk, which again is just about the current price of the bond will fluctuate. There is that volatility. You have political and event and sector risks. So those are more company-specific risks. So sometimes a company, they could have a lot more credit risk than another, and so the price of that bond would be different than a T-bill or something like that. So you do have that risk as well when you are buying corporate bonds, especially, is that their credit rating could change and things like that. Now, looking at debt market trading, so you do have over-the-counter trading. So in Canada, there is not a centralized exchange. Debt is typically bought in the secondary market from investment dealers who quote a bid price and an offer price. The spread between the bid and offer determines the liquidity of the debt, and on-the-run investments are more liquid, whereas off-the-run are less liquid. And you can see the impact of commissions. So commissions do definitely play a factor in bonds. You can see that the commission usually goes up with the term of the debt, but it does factor into the yield a little bit as well. So the estimated effect on the yield, you can see, ranges from 9.7 to about 12.8 basis points. Now, the yield curve. So this is something that is quite important for bonds. Right now, we are actually in an inverted yield curve. So you can see that the yield is higher for the shorter term maturities. And the reason for that is because the expectation is that interest rates are going to go down in the future. Now, normally you have just a normal yield curve where you get a higher yield for locking in longer, for a longer maturity. But with situations where interest rates are expected to go down in the future, or we are expected to go through a recession, that's when the inverted yield curve comes up. And then in between, there is sometimes a period where the yield curve is flat. So that's where the yield is the same no matter what the maturity would be. Now, there can be different shifts in the yield curve, so there could be a parallel shift up or down. That's just when the yield curve just shifts up or down level depending on the maturity. Flattening the yield curve is when that normal yield curve starts to become more flat, so the longer term rates aren't as different than the shorter term rates, but they still are a little bit higher. Steepening the yield curve is the inverse of that. So the longer term rates are much more competitive or much higher than the shorter term rates. You also have humps sometimes. So that could be something like where the 1 and 2 year rates are higher than the medium term rates, so maybe the 5 and 10 year, but the 20 and 30 year are just as high as the 1 and 2 year. You can also have the inverse where the medium-term rates are higher than the short and long-term rates. And so those are the different types of yield curves. That is it for Chapter 20. Those are all the most important concepts of Chapter 20. So I will see you in Chapter 21.